India's FMCG sector is one of the most stable, cash rich, and defensive sectors in the stock market. But how do you analyze FMCG stocks like HUL, ITC, Nestle, Britannia, or Dabur before investing? In this video, I'll give you a complete step by step analysis framework with real examples so you can evaluate any FMCG company confidently. Let's begin it. So, the first step is to understand the business model. I'm really sorry for my handwriting, but चला लो यार, ठीक है. FMCG companies sell high volume, low margin essentials products like food, beverages, personal care, cleaning products, etc. Like examples, if I have to give, HUL, they are into like skin care, then they are into home care, they are into packaged food, and the companies like Nestle India, they are into noodles, coffee, baby food. ITC FMCG, atta, biscuits, snacks, personal care. Dabur is into Ayurvedic products, honey and juices, right? So understanding the business model means you have to ask your 2 3 questions. Ask yourself, the first, ask yourself, I'll give you the questions which you need to answer yourself in order to understand the business model. The first question would be, is the product essential? Is the product essential? Second question you need to ask yourself is demand is recurring? And third question you need to ask in order to understand the business model is, are customers brand loyal? So these are the three ask yourself questions in order to understand any company's business model. Okay, is the product essential? Is the demand is recurring? Are the customers brand loyal? Okay, the next step is analyze brand strength and market leadership. See, FMCG thrives on brand power. Real examples I have to give you, like HUL dominates the market with Surf Excel, Toe, Lux, Rainbeam, etc. Like Nestle India owns 60 plus year old brands like Maggie and Nescafe, and Britannia leads in biscuits and bakery items. So you need to check here when you're going for brand check, what are the points you need to consider? The first point is, check the market share of that company. Second, their product leadership in categories, in different kind of categories. And third is again customer loyalty. So this is the very major important point when it comes to FMCG. And the last is, what is their advertising strategy? You need to understand one thing, a strong brand is equal to bigger pricing power. It's an important point, don't forget. Okay, let's move on to the next point. The next step is checking the pricing power and premiumization. Premium products drives the margins. Example, Marico introduced premium hair care and skin care lines. HUL shifted their consumers from basic to premium detergents and beauty products. So here you need to ask, What you will need to evaluate? The first thing, can the company increase prices without losing the customers? The most important point. And are premium SKUs are growing? So in order to get pricing power and premiumization, you need to see if the company can easily increase the price without losing their loyal customers and the premium SKUs are growing or not. The fourth, we'll continue here only. The fourth step is to check the distribution network. And I think network strength. Distribution is the backbone of any FMCG company. HULs, they have like 8 million plus retail outlets reach. Daburs has a very strong rural network, and Britannia has a very deep penetration in the small stores as well. So you need to evaluate what the things you need to evaluate in order to see what are the distribution channel or the strength of it. The first point you will see their company's urban versus rural presence. Second, general trade plus modern trade share. The next point is company's e-commerce contribution. And last would be supply chain efficiency. Companies with wider reach scale faster. That is the main point here I need to explain under distribution network strength. Let's move on to the next step, that is volume growth versus the value growth. We need to understand volume growth versus value growth. So FMCG performance depend on the volume, that is units sold, and value, that is price multiplied by the units. Example, when rural demand is weak, companies show low volume growth. You need to this is a example trend. When there is if we, like I said, like we have a which company, they has a very good rural thing, they have a very good penetration in rural areas. So if their demand goes down from there, right, demand is weak from the rural areas, they will show their volume growth will go down. And brands with strong loyalty like Maggie sustain the volume even during the inflation. If the price goes up but the product is so good that they will, like, people will eat, never mind कि नहीं कितना भी जाने दो price, they don't bother about it. So look for consistent volume growth across the category. You need to look for consistent growth in terms of volume, not in value. Across categories. Next step is financial analysis. Obviously this is a very big thing, and I am going to take a separate session on fundamentals, how to analyze the fundamentals of any company. I am being if you are interested, you can contact me. My WhatsApp number is there in the description. You can contact me there, and then we'll see. In that you can learn to evaluate the things. Just a moment. Purushottam. A little disturbance, guys. बंद करो दरवाजा. Yeah, this keeps on happening in my live sessions as well. It's okay. Let's move on. Let's focus on our financial analysis. So while doing the financial analysis, what are the things you need to consider? The first would be revenue growth. See, I am not going to edit and everything. These whatever I'm recording right now and whatever the knowledge I'm passing on, it's raw. Okay, it is going to be the real data. No fancy editing and cutting and all the things. It's a pure raw data. A pure knowledge is getting passed on. So enjoy this thing. So revenue growth, is growth consistent? Companies like Nestle tend to show steady and predictable growth. The second most important is operating margins for any FMCG company. In this we call as like EBITDA. High margin is equal to strong pricing powers. ITC's FMCG margins have been steadily improving. You can have a look at it. The second is cash flow. Third, I mean to say, FMCG stocks are cash machines. Positive operating cash flow, low working capital requirements is the key factors to keep the companies profitable. Okay, the next you need to see is return ratios. Which ratios? Return on capital employed and return on equity, ROE and ROCE. High returns are equal to efficient operations, and HUL is a classic example of high ROCE, capital employed, for decades. You can have that figures in the Google, and you can get it compared with any other FMCG, and you will find that HUL been leading in this ratio. Let's move on to the next step. That is step number 7. That's raw material dependency and inflation impact. This is most important point. Raw material dependency and inflation impact. So FMCG margins move with commodities and prices. Example, if I have to give you, like Britannia is very sensitive to wheat and sugar prices. Marico depends heavily on the copra prices. HUL is affected by the crude based inputs like packaging and chemicals and everything. Track the input cycles, they directly affect the margins. You need to track the input cycles, which will definitely guide you. They these things directly affect the margins. Let's move on to next step, category diversification. So single category companies are riskier. Example, Dabur is well diversified across healthcare, food and personal care. If you see ITC, FMCG has expanded into biscuits, noodles, snacks, hygiene, chocolate. So in FMCG case is more categories are equal to more stable revenue. This you need to consider. The next step is competition and market disruption. So India's FMCG landscape changes very quickly. Very quickly. Examples, Mama Earth disrupted the skincare segment. Patanjali disrupted the Ayurvedic and natural products. Tata Consumer aggressively entering new categories day by day. So you need to check if the company is innovating or losing its share in the market categories, in the different categories. You need to see if the company is innovating or not, or they are losing the market share to some other companies. So this was the ninth point. Let's move on to the next step, that is valuation check. FMCG stocks usually trade high PE multiples due to stability, this price to earning ratio, right? But compare valuation with their peer companies. You need to compare it with peer companies. Check their growth rate, also again ROCE and cash flows. See example, HUL often trades at premium valuation due to market leadership and stability. So that is why this is valuation check is the most important. So these are the 10 steps. If I have to conclude it and summarize, give the summary of everything. To analyze any Indian FMCG stocks, you need to focus on the first thing is brand strength. The second is their distribution power. Third is pricing ability. Fourth is financial consistency. Fifth is raw material exposure. And the last point is valuation. So use this checklist and apply it to the stocks like HUL, Nestle, ITC, Britannia, Dabur, Marico, Tata Consumer, or any FMCG players, and you will see which are the market leaders. I hope you like this video. If you like this video, please share with your trading friends. Please share with your friends. Stay connected. Subscribe to the channel. Comment on the which part of this video or which company do you want me to analyze for you. Okay, so comment that name in the on the comment section of this video. So that's it from my side. Love you all. God bless us. See you in some other video. Bye bye. Take care.